Hey, what's up guys? Warren Buffett and Charlie Munger are very likely preparing themselves for a big market decline. In this video, I will present some evidence why those billionaires position their company for a potential recession. Charlie Munger, the right hand of Warren Buffett, is very concerned of the current market conditions. Maybe right now it's just not the best idea to put all your cash to work. Let's take a quick look what Charlie Munger had to say in this recent video.
We've got some comments from Berkshire Hathaway's Charlie Munger to the Journal this morning. He says, I would basically say we're like the captain of a ship. When the worst typhoon that's ever happened comes, we just want to get through the typhoon. We're not playing, oh, goody, goody, everything's going to hell. Let's plunge 100% of the reserves back into buying businesses. He also says on the economy, of course we're having a recession. The only question is how big it's going to be, how long it's going to last. I don't think we'll have a long-lasting Great Depression, but we may have a different kind of mess. All of this money printing may start bothering us.
He said that of course we're going into recession. The only question is how big it's going to be and how long it's going to be. Maybe and hopefully we are not going into long-lasting depression like we had in 1930s. But indeed, the Fed expands its balance sheet by trillions of dollars weekly, and just printing money like there is no tomorrow, it might not end well for the whole global economy. Let's take a look at Warren Buffett indicator. Market cap to GDP is a long-term valuation indicator that has become popular in recent years, thanks to Warren Buffett. Back in 2001, he remarked in a Fortune magazine interview that it is possibly the best single measure of the whole valuation stand at any given moment. The numerator is equal to Wilshire 5000 Total Market Cap Index, which is a market cap index representing the value of all stocks traded in the United States. The current total market capitalization is around $29 trillion. The denominator is quarterly United States GDP. The current GDP is at around $22 trillion. So if we do simple math, one apple plus another apple equals to apple. Oh wait, that's not it. 29 trillion divided by 22 trillion equal to 1.33 or 133%. But you may be wondering, what does that even mean? Well, here what that means. According to Warren Buffett, the fair value is in between 75 to 95%. Anything below 75 considered to be undervalued, and anything above 95% is considered to be overvalued. Currently, total market cap to GDP ratio is at 133%, which is significantly overvalued. So here is why Warren Buffett is sitting on a pile of cash. He who has cash in a recession is a king. In 2008 housing bubble, TMC to GDP ratio was over 100%. When the housing bubble burst, the ratio dropped all the way to 50%, which meant the stock market was significantly undervalued and it was a perfect time to buy in. In 2000's dot-com bubble, valuation was extremely high. The ratio was over 130%, similar to the current evaluations. When 2000's dot-com recession came to the end, the total ratio dropped below 75%. Just recently, TMC to GDP was over 150%, which is the highest we have ever seen in the history. Recently, it dropped to the 130%, which is still astronomically high. I believe in the near future we will see this ratio below 100% or even at the same level where it was in 2000's dot-com bubble, that is 75%. But you may ask why I think that. It's mainly because of the mean reversion. No wonder why Warren Buffett is currently sitting on so much cash, and he even selling some airline stocks. Let's take a look at this quick video where Warren Buffett and Charlie Munger explain why Berkshire Hathaway has so much cash on the balance sheet.
Warren, you are a big advocate of index investing and of not trying to time the market. but by your having Berkshire hold such a large amount of cash and T-bills, it seems to me you don't practice what you preach. I'm thinking that a good alternative would be for you to invest most of Berkshire's excess cash in a well-diversified index fund until you find an attractive acquisition or buy back stock. Had you done that over the past 15 years, all the time keeping the $20 billion cash cushion you want, I estimate that at the end of 2018, the company's $112 billion balance in cash, cash equivalents, and short-term investments in T-bills would have instead been worth about $155 billion. The difference between the two figures is an opportunity cost equal to more than 12% of Berkshire's current book value. What is your response to what I say? And I forgot to say the question is from Mike Elzar, who is with the Colony Group located in Boca Raton, Florida.
That's a perfectly decent question, and I wouldn't quarrel with the numbers. And I would say that is an alternative, for example, that my successor may wish to employ, because on balance, I would rather own an index fund than carry treasury bills. I would say that if we'd instituted that policy in 2007 or 8, we might have been in a different position in terms of our ability to move late in 2008 or 2009. So it has certain execution problems with hundreds of billions of dollars than it does if you were having a similar policy with $1 billion or $2 billion or something of the sort. But it's a perfectly rational observation, and certainly looking back on 10 years of a bull market, it really jumps out at you. But I would argue that if you were working smaller numbers, it would make a lot of sense. And if we're working with large numbers, it might well make sense in the future at Berkshire to operate that way. You know, we committed $10 billion a week ago, and there are conditions under which, and they're not remote, they're not likely in any given week or month or year, but there are conditions under which we could spend $100 billion very, very quickly. And if we did, if those conditions existed, it would be capital very well deployed and much better than in an index fund. And so we're operating on the basis that we will get chances to deploy capital. They will come in clumps in all likelihood, and they will come when other people don't want to allocate capital. Charlie, what do you think about it?
Well, I plead guilty to being a little more conservative with the cash than other people, but I think that's all right. We could have put all the money into a lot of securities that would have done better than the S&P with 20/20 hindsight. Remember, we had all that extra cash all that period if something had come along in the way of opportunities and so on. I don't think it's a sin to be a little strong on cash when you're as big a company as we are. We don't have to. I watched Harvard use the last ounce of their cash, including all their prepaid tuition from the parents, and plunge it into the market at exactly the wrong moment and make a lot of forward commitments to private equity. And they suffered like 2 or 3 years of absolute agony. We don't want to be like Harvard.
Plus timber and a whole bunch of things.
What?
I mean, plus timber and I mean.
Yeah. We're not going to change.
No. We do like having a lot of money to be able to operate very fast and very big, and we don't. And maybe we won't. We know we won't get those opportunities frequently. I don't think. Certainly, in the next 20 or 30 years, there'll be 2 or 3 times when it'll be raining gold, and all you have to do is go outside. But we don't know when they will happen, and we have a lot of money to commit. And I would say that if you told me I had to either carry short-term treasury bills or have index funds and just let that money be invested in American generally, I would take the index funds. But we still have hopes. And the one thing you should very definitely understand about Berkshire is that we run the business in a way that we think is consistent with serving shareholders who have virtually all of their net worth in Berkshire. I happen to be in that position myself, but I would do it that way under any circumstances. We have a lot of people who trust us, who really have disproportionate amounts of Berkshire compared to their net worth if you were to follow standard investment procedures. And we want to make money for everybody, but we want to make very, very sure that we don't lose permanently money for anybody that buys our stock somewhere around intrinsic business value to begin with. We just have an aversion to having 1 million plus shareholders, maybe as many as 2 million, and having a lot of them ever really lose money if they're willing to stay with us for a while. And we know how people behave when the world generally is upset, and they want to be with something. I think they want to be with something that they feel is like the Rock of Gibraltar, and we have a real disposition toward that group.
Warren Buffett tried to explain why Berkshire Hathaway 30% of market capitalization is in cash. $128 billion is in cash, comparing to $450 billion of market capitalization of the entire Berkshire Hathaway company. That's a lot of cash. The main reason they told that they hold cash is because Warren Buffett cannot find great businesses and decent prices. Well, how could you find great businesses at decent prices in such a highly overpriced stock market? But there will be one day where we're going to have rain gold. You just have to go outside and pick up gold or assets, pennies on the dollars. And that time might be soon. Already we have seen some cracks in the market. Market dropped in the fastest pace in the recent history. 35% in just 4 weeks. We slightly rebounded, but we will see what will happen when publicly traded companies will report second quarterly earnings. Quite frankly, Warren Buffett was quiet during this downturn market with his investment positions. We do not know exactly if he deployed any of his cash to work or if he sold even more stocks to get more cash. We will find out when Berkshire Hathaway will release first quarterly earnings in early May. But we do know for sure that Warren Buffett sold a decent size of his airline stocks. If you look at this chart, we can see that Berkshire Hathaway cash position decreases when stock market drops and increases when stock market grows. After the housing bubble in 2008, market evaluations were very attractive, and Warren Buffett was able to find many bargains. But we cannot say the same about current time. It doesn't seem like it. We will find out shortly when Berkshire Hathaway will release the first quarterly earnings. Let me know what do you guys think about Warren Buffett and his cash position. Leave your thoughts in the comment section below, hit that like button, and subscribe